Personal finance practice problem using OneNote. Option to receive money today versus a series of payments. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, the Practice Problems tab, down in the 1210 option to receive money today versus a series of payments tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got the information up top, calculation on down below. We're going to go through a situation which is often frameworked in, say, a lottery type of situation, which is probably the most classical type of framework, meaning, what if you were in a situation, you won the lottery, you can either get the money today or you can get it into some series of payments in the future, which would be a better option. Any kind of payout scenario could have a similar type of situation. So if there's a lawsuit settlement or insurance settlement or something like that, you may well have a situation or could possibly have a situation of a similar nature, a payout at one point in time or a series of payments into the future. So anytime you have that situation, then for our example, we're going to say that we have the $45,000 today versus a series of payments, which would be 7,000 payments each year for 9 years. Now, when you first look at that, we'd say, okay, and they probably wouldn't give you, in this situation, you wouldn't really know kind of the rate. You'd have to assume what the rate is, and that's one of the difficult components to a question like this. So obviously, if I took the 7,000 and multiplied it times 9, we get 63,000, which we also calculate down here, which of course is greater than the 45,000. So it would seem better to get the series of payments for 9 years. But then that means that we got to wait 9 years before we get the full amount of the payments, and we have to take into consideration time value of money. Now, in this situation, we often think of, well, time value of money, does that just mean inflation? Because we know that the purchasing power of the dollar will go down. If we're talking US dollars, the Fed actually shoots for between like 1 and 3%. So inflation is something that we got to take into consideration clearly, because just simply the purchasing power will be less in the future. But that's not the only thing you want to consider when getting to this rate right here. We also want to think about opportunity cost, meaning if I got the 45,000 today, then I could do something with it at that point in time, and as opposed to if I got it later. And I might just spend it. If I need the money, then I can spend it, in which case I'm probably getting a pretty good return in terms of usage, given the fact that I'm using it and need it at this point in time. Or if I don't need the money, even if I don't need it at all, I can still invest it. And if I invest, hopefully I'm going to be making more than simply the rate of return to keep up to date with interest. I'll hopefully choose an investment which will be over and above the 1 to 3% that I could get in interest. And we're going to assume here that basically we're going to say 7%, right? So if I think that that's kind of where you would get the percent for the discount rate, you'd have to say, okay, what kind of discount rate should I be using when I figure out the amount of the payments, the series of payments for the annuity? And basically, you're taking into consideration what your opportunity cost would be if you had the money today and you were going to basically invest it somewhere. What kind of return might you be able to get with that? And you might say, I wouldn't invest it. I'd spend it. I need the money. I want to spend it right now. Well, if you need to spend it right now, then you're probably getting a good return on it, because you actually need the money at this point in time. So again, you might choose a fairly significant return in that case, and given the fact that the cash flow is valuable to you at this point in time, you might think about what you would be willing to borrow the money for and that kind of thing. So that's going to be the key factor. We're going to say 7% here. Then we're just going to say, well, the 45,000, that's in today's dollars. And then the series of payments are something that I've got to bring them back to today's dollars so I can compare the same thing to the same thing, apples to apples, as they say. To do that, we'll need to take that series of payments and bring it back with the present value of an annuity, which would be, first, let's do that in an Excel type of calculation, in a function, which would probably be the easiest way to first think about it, and then double check it with basically a series of payments. And we'll also kind of think about it in terms of a future value calculation, which I think can make this one a little bit more solidified in some cases. So we'll say the present value would be the negative present value of the rate. The rate would be then the 7%, which we're pulling from the table. That's why there's a B5 here, so that if we wanted to test out different rates, we could do so. If we wanted to increase or decrease the rate to see what the result would be, we could do that if we set up our table properly. And then we're going to say comma, number of periods, which we're going to say is 9, and then comma, the next one would be the payment. The payment is going to be the 7,000. That would then give us the result of the 45,607. Now, if we compare that 45,607 to the amount in terms of today's dollars that they gave us, which was the 45,000, then we have a difference of the 607. The two are pretty close, but the series of payments at the 7% is giving us a better option over at that 607 over and above when we present value the two of them. Now, instead of doing a running balance, I think sometimes it can be useful for us to think about this in this format. So when we think about this series of payments, it's sometimes easier to look going forward when we're thinking about the annuity. So, for example, if I'm getting $7,000 a year for 9 years, and I think I could then invest that money as I get it and get a 7% return, you might say, why don't I think about what the future value is of that series of payments, and then imagine I put this $45,000 into an account and receive the 7% per year, give us the future value then. And just note that as long as you're doing a comparison where you're comparing the same thing to the same thing, you can do a comparison. In this case, we would be comparing future value to future value, and then we can discount that back and we can get to our same kind of result. So sometimes this type of calculation makes this thing click a little bit more for people. Note that in practice, usually the common thing that we will do is bring the items back to the present value and compare them in the present. But if you're comparing as of the same point in time, that's kind of the goal. And again, sometimes people can visualize the future value calculation for something like this annuity a little bit easier. So let's just do that now. We're going to say, what if we took the future value? And now we're going to start off actually with the future value of this 45,000 and say, okay, what if I took that 45,000 and invested it at a 7% return for 9 years? It wouldn't be an annuity. It would just be an investment receiving that 7%. Would look something like this. We'd have the negative future value. The rate would then be the 7%, comma, number of periods would be 9 periods, comma, and this one would not be an annuity. We're just talking about a payment at this point that's going to be accumulating the interest for 9 years at the 7% compounded yearly. So we're going to take the present value, which is that 45,000. That then gives us a result in the future of 82,731. So in the future, under those circumstances, we would assume 9 years from now, this 45,000 would be in future dollars, 82,731. If I did the future value of the annuity, meaning this series of payments, assuming we get the 7% return over 9 years, that would look something like this. Future value is the rate, which would be the 7%, comma, number of periods would be 9, comma, and then the payment then, this one we're using the payment because this is an annuity, would be the 7,000. That gives us the return of 83,846. The difference between those two is that 1,115, the annuity once again being slightly higher than the lump sum amount in future value terms. Now you might say, well, how does that 1115 tie into this difference we got before when we looked at the present value calculation? Note that this difference that we got to is now kind of a lump sum that we're estimating in future value terms, which is 9 years out from today. So if I was to present value that number back to the present value, then I should get then to this present value difference once again of the 607. And so we could say, okay, let's take the present value of that term, which would be the rate of 7%, comma, number of periods, which would be 9, comma, we do not have a payment because it's not an annuity, so 2 commas, future value would be this 1115, discounting it back 9 years back to the present value would give us back to that 607. So I think that's kind of useful to do because I think sometimes when people verify the annuity payments, it's sometimes easier to think about the table go into the future and verifying basically this number here. And it's useful to kind of see how the present value and future value are related in that way. Let's do the calculations that we might do in a school setting, which would be including the mathematical formula and then the tables. Mathematical formula is going to be P is going to be equal to the payment, which is the 45,000 times 1 minus 1 over 1 plus R, 7%, to the power of N, number of periods, 9, divided by R, 7%. You can plug the numbers into the formula, work them algebraically. We're going to plug them into our table down below, as we might see in like a tax return or financial statement, and work it in that format, practicing putting our tables together or at least visualizing them. So we got the payment on the left times this amount, this whole thing. I want those two to be ending in the outer column, subcategories in the inner columns. Payment, 7,000, outer column. And then we have the numerator, which is going to be this 1 minus 1 over 1 plus the R. So there's the 1. I'm going to call this numerator 2 because that's going to be this category, that numerator right there. And then we're picking the 1 plus R to the N, which is going to be this bottom portion. And then we have a colon pulling that inside, 1 plus R, 7%. That's going to give us a subtotal 1 plus 7%, 107, to the number of periods, which is 9, to get us then to our outer column number. Let's do that, making sure that we have a calculator that can take to the power of 9. For me, scientific calculator. So we'll take the 1 plus 0.07 gives us 1.07 or 107% to the power of XY, giving us the caret to the power of 9. And there we have the to the power of 9. Didn't do it. Hold on a second. Let's do that again. Clearing that out, we've got, let's start at the 1.07. X to the Y to the caret of 9 should give us 1.83846 about. Back to the standard calculator, and there we go. I made a slight, the scientific I'm not as scientific-y, so I messed up a little bit on the scientific, but we're back to it here. Then we'll take the 1 over that whole thing, which is right here, 1 over that whole thing. So we're going to say 1 divided by the 1.83846 about gives us about 0.543934, and so on. Then we'll take 1 minus that to give us the numerator. So here's the 1 minus that in the same column. 1 minus the 0.543934 about gives us about 0.456066 about. Then we got the denominator, which is the rate. So it was the rate. So we'll say that's 0.07%. So then we can take the 0.456066 divided by 0.07 gives us about 6.51232 about. Taking that and multiplying it times the payment, which is the 7,000 times 7,000, finally gets us to about 45,606.63. This number is a bit more accurate down here because the numbers in Excel will calculate the actual numbers even though we can only see so many decimals. Now let's do it with the tables. Fairly straightforward table problem, making sure that we pick the proper table, noting that we typically are going to be having 4 tables to choose from. 2 present value, 2 future value, both having an annuity and non-annuity format. We're looking for the present value annuity calculation table. We're going to just take simply the 7,000 times the amount from the table found in 7%, 9 years. So we're looking 7 and 9. 7 and 9 gives us the 6.5152. So there's the 6.5152. Multiplying that out, pulling the trusty calculator over, we got the 7,000 times 6.5152 gives us 45,606 about. Remember that the tables are rounded to 4 digits, which is the actual numbers closer to the 6.5152. It has more than 4 digits, so you could have a rounding difference between the tables and the more accurate calculations using Excel functions and the mathematical, formulas.